Our next topic we will talk about is basic cost management concepts. This will go over some of the terminology that we need for this course, as well as some of the definitions. And I want to point out where some of these things get a little bit fuzzy. It's kind of the nature that there's a little bit of contextualism in some of these terms when you're trying to define them, and I'll go over where you might run into those, what to look out for when that happens. So the first thing that we want to talk about is this concept of a cost driver. What drives a cost? And so if you think about like an Uber driver, um, the cost to that Uber driver is going to be the distance traveled, and possibly if they're in a traffic, high traffic environment, maybe the time it takes to drive someone there. So you've got that would be your cost driver. If you're in a manufacturing situation, the cost driver for direct materials would be the number of units made. If you were an attorney, it's the number of billable hours, those sorts of things that go in there. If you're preparing tax returns at H&R Block, it would be the cost driver would be the number of returns prepared. And the reason I say the number prepared in that situation is that H&R Block is a volume tax business. So yes, you're going to have some returns that take longer than others. Um, but on average, you're going to have a pretty consistent average year to year of how long it takes and what's involved. Whereas at a high end tax firm, like a public accounting company, a regional or a big four accounting firm, the cost of a tax return would be the number of schedules prepared on a given tax return. And so the idea is a cost driver is anything that you can that when it goes up, the costs go up. If it goes down, the costs go down. So there's a high correlation to that. It may not be perfect, but it's a very high correlation. The next term that we have is something called a cost object. This is one of those really fuzzy terms because essentially it's anything that that we want to apply a cost to. So it could be a subcomponent, it could be a unit produced, it could be a service that we provide, it could be it could be a factory unit, or it could be a unit of the organization. So the cost object is anything that we assign a cost to. Well, now I'm getting in the term cost assignment. And so we have two different ways of assigning costs. Now there's lots of subways within these ways, but the two broad categories of cost assignment are direct cost. So a direct cost is anything that we can see either the material, if we're talking materials, or the effect of the materials in the in there, or if it's labor, it would be we could see somebody put that together. The other cost way to do it is indirect costs, and we assign or we allocate those costs, and this is generally true for overhead. So let's take let's take direct materials, or let's take materials for example. A direct material, um, let's say a direct material in the food industry would be a steak, right? So we're going to prepare a steak for a customer, and that would be a direct material. An indirect material um, would be when we have a grill, we have one of those grill bricks to scrub the grill. Now, the customer really doesn't care how we scrub the grill or what we use to scrub the grill, only that it's a clean grill that we cook their particular food on. and the customer never sees that grill brick. Costs, on the other hand, a direct labor would be the cook, and the indirect labor would be the supervisor or the foreman there. So we see what the cook did to the food. We don't see the kitchen supervisor. What we don't see what they do. They just make sure that things run smoothly, get out on time, that sort of thing. We don't see it in the actual product. Um, Indirect materials and indirect labor generally fall into a category known as overhead. And of course, overhead is one of those things we want to minimize whenever possible because, again, the customer doesn't see the overhead. We could have we could have a place in Manhattan to manufacture something, or we could have a place out in Kansas. Well, the same size factory in Manhattan is going to cost us, 4 or 5 or 10 times as much as that same factory in the middle of Kansas somewhere. And so that factory building eventually those costs associated with either renting it or building it are going to show up in the price. And so that's an indirect cost or an overhead. Indirect costs and overhead are not perfectly synonymous, but are usually very close to synonymous. So when we talk about materials, we have direct materials. If we were to take, let's say, an automobile, our direct materials would be the metal for the body. It would be the tires that go on there. It would be the seats that we install. It would be the transmission. It would be the engine. All those things are direct materials. Indirect materials would be like once we have the body built and we're ready to paint it, we're going to run solvent over it to make sure that the body is clean and the paint will adhere. But you don't end up with the solvent when you buy that car. So that would be an indirect material on the car. Anything. Sometimes we have jigs that are disposable, like if we're casting aluminum or metal or something. We'll have a form that is destroyed when we cast it, lost wax method of casting things. That would be an indirect material on that sort of thing. And then labor, direct labor is anything on the assembly line, but the supervisor, even though the supervisor is supervising the assembly line, that would be an indirect labor. So with indirect labor, we can't see the result of what they do in the product itself. And then, so all this indirect stuff, indirect materials, indirect labor, all falls into this category of factory overhead. Now, the factory overhead is a very real cost, and we need it. If we're making silicon wafers, we have to have a clean room that does that. And so that clean room and the air purifying system and all that stuff, we don't see when we buy a computer chip, but we certainly are appreciative that it's there and it's necessary in order to do that. Okay, so direct materials and direct labor, when you add those together, are called prime costs. And so let me draw a graph of that. Or not necessarily a graph, a chart. So when we do we have direct materials, we have direct labor, and we have manufacturing or factory overhead. These two together, direct materials and direct labor, are called prime costs. So that's what goes into the actual thing. Then these two together, direct labor and manufacturing overhead, are called conversion costs. Now, it should be pretty apparent that we can't add prime costs and conversion costs together and get anything meaningful because we would be counting the direct labor twice, right? So when we add these all together, direct materials, direct labor, and manufacturing overhead, those three together are product costs. Now, what does it mean for something to be a product cost? It means that the cost gets attached, in an accounting sense, gets attached to the thing that is produced or the service that is being performed. Okay, so, and what that means is product costs end up either as cost of goods sold when we sell it or in inventory if we don't sell it, manufacture it, but don't sell it. And so that's a very important concept that we'll talk about throughout this 8-week period. The semester will be the product cost. Now, I'm going to warn you, a little bit later this chapter, we will be introduced to two different types of accounting. You're familiar from your introductory class, of those of you who had undergraduate accounting, you had financial and managerial accounting. But for those of you who took 6301, it primarily focused on financial accounting, and that another name for that, or two names for that, is full cost accounting or absorption accounting. Those are two names that are used for that type. Well, we're going to learn another type of accounting. Here, we use both of them. We need both of them, and that is called contribution margin or manufacturing accounting, or sometimes it's called CVP accounting, fixed and variable cost accounting methods. And we're going to get a little bit more into that a little bit later in this video, but we'll get a lot more into it in the next couple of chapters that we go down. Okay, so that's product cost, prime cost, and conversion costs that go together. All right, the next thing that we have to worry about is the types of costs. And this, we're going to talk about variable costs, fixed costs, mixed costs, so costs that they have both a variable and a fixed component to it, and then a type of cost known as step cost. Okay, so the first thing, let me flip the page here. The first thing we want to talk about is variable cost. A variable cost happens, is based on volume. So the more we do, the more it costs. So let's take a graph. And this is going to be costs in total. So on the horizontal axis is the volume, and on the vertical axis is the dollars spent. So a variable cost will start here. If I don't produce anything, I don't have any cost. and it will go up linearly, right? Like this. And right now, you might be asking yourself, well, what about this idea, that we introduced in the last video about economies of scale? And if I buy more, don't I get a cheaper price? And the answer is yes. What happens? Let's say, um, again, we'll use cost in total. And if I start out, I might go like this, but then they slowly, slowly, slowly get more and more, right? They get lower and lower. So, so again, this is our dollars, and this is our volume of purchases. And each incremental one, to some point gets less and less. So what happens here is something known as the relevant range. And you can see it's not perfect, but it's almost linear here, right? There's a little bit of a bump, but it's almost linear. And what we talk about when we talk about the relevant range is the range that we will be operating in. We're not going to make 10 laptop computers, right? Down here. We're going to make laptop computers in the thousands or tens of thousands. So we're going to buy our computer chips and our memory and our screens and all the things that we have to buy. We're going to buy in the thousands and tens of thousands. And so the range that we are operating in will be almost a linear price, and we can use a set price. And so what that means when we get down to the last part is now we're going to look at a unit cost, and we get a variable cost unit cost just looks like that. Each unit costs a set amount, right? Each unit costs a set amount. So when we add all these together, we sum them up, we get a total variable cost that is linear on that. Now that's important because obviously as we go up, it goes up. All right, the next one we want to talk about is the fixed cost. Now, a fixed cost might be something like our factory rent. It doesn't matter whether we make 100 units, 1,000 units, or 10,000 units. As long as our factory floor is big enough to handle it, our cost is fixed. And so our cost in total again so this is the volume, the number of units produced, and this is the cost. And that's going to look flat, right? Again, now it's obvious that if we outgrow our factory, we're going to have to go lease a bigger factory or an additional factory, one or the other. And so, yes, technically that cost has some variability, but that gets back to that concept within the relevant range that we are operating in, that cost is fixed. So, if my capacity is 10,000 units in a month in a factory, and I'm normally selling between 3 and 6,000 units, six on the high side, three on the low side, my lease on that building is pretty much fixed, or my property taxes are pretty much fixed. That's not going to change in one accounting period. Okay. But then that leads us to what does our this is our total cost. What does our cost per unit look like with a fixed cost? Well, if I make one, my cost is here. And if I make 2, my cost per unit is halved, right? So if I have a factory and I'm paying $2,000 a month and I make 1 unit, that factory costs the overhead for the factory costs $2,000 per unit. But if I make 2 units, it only costs me $1,000 a unit. And if I come out here and I make 4 units, right? Now it only costs me $500 per unit. And if I make 8 units, come out here, then it only costs me $250. And so we get a function that gets closer and closer and closer to zero. And this, by the way, is where we get so many of our cost efficiencies. If we can have fixed costs, right, that's where, and we can increase our production with those same fixed costs, then the fixed cost per unit decreases. This is per unit. And that's the advantage that larger companies have over smaller companies, is they can spread these overhead costs over more units that they're manufacturing. Okay, so the next one that we have is a mixed cost. Well, what's a mixed cost? This is something that has a fixed component, but also has a variable component. So if we look at our graph, a mixed cost will have the shape of a variable cost, except it doesn't start at zero, right? We have so much that we have to pay. This might be like, there's a number of things, like would be my water bill. They charge me $65 a month, even if I don't use any water. If I go on vacation, don't use any water, don't take any showers, wash any dishes, all that kind of stuff, they still charge me $65 a month. But then after I use like the first 2 units of water, they start increasing the cost. So it has the shape of a variable cost, except it doesn't start at zero. It starts at some positive level there. So that would be a mixed cost. The way we treat this for accounting purposes, for this managerial accounting, cost accounting, is we split those into the fixed and variable component. And so we treat part of it as fixed and part of it as variable. And then finally, the last one we have is known as a step cost. And so this one starts out with a cost and it just goes up in steps. I think about this anything that we have to lease, like maybe forklifts. If we have just one forklift, we'll lease the forklift and it costs us down here. But if our volume increases to where we now need 2 forklifts running to keep up with demand, we increase the price here, and they're pretty much so what. One way to look at it is that a step cost is a fixed cost with a really, really short relevant range, right? The amount it's short that we're comparing it to. What we generally do here, depending on the size of the steps, but generally we treat it as a variable cost. For purposes, and to be honest, within the textbook, this class, it's not going to become a big issue, except in this chapter, you need to know what it is because you could possibly get some questions of what is a step cost. But in terms of actually working problems and stuff, There's not many that involve step cost within this textbook or any accounting textbook for, and like I said, most of the time we just treat it as a variable cost if they're small enough steps to be able to do that. So what we end up with is a total cost. Now the total cost looks a whole lot like the mixed cost because we have both fixed and variable. So if we were to layer, here's our fixed cost, and here's our variable cost like this, then we add them together and start here, and it will have the same slope as the variable cost, but it starts at the fixed cost point. So this is our total cost, and it looks just like the mixed cost did, right? Now, let me impose upon that a revenue line. Let's see if I've got a red pen. I don't think I've got a red pen here. Now let's put our revenue line here. Here's our revenue line. And this will be important a little bit later. The first thing you need to know is your revenue line needs to have a steeper slope than your variable cost line. If it doesn't, then the more you make and sell, the more you lose, right? So if my revenue line were the dotted red line, well, here I only lose the amount of my fixed cost if I don't do anything. But if I come out here, my loss gets this big, right? Much bigger here than here. So my revenue line has to be steeper than my variable cost line, or just stop what you're doing, right? You lose the least amount of money by doing nothing, or at least, without changing something up pretty drastically. And that's fine. So let's redraw this so it's not quite as messy. Um, our total costs. So here's our total costs. And then here's our revenue line. Steeper than our variable cost line. This point, which we'll get into in the next chapter in a lot more depth, is known as the break-even point. So down here is loss, and up here is profit, right? So obviously we want to be in the profit range. So break even will be a very, very important point to us as we go forward for this sorts of thing. Okay, so that's one way of looking at things, fixed costs versus variable cost. There is another way to look at things. And we already touched on it a little bit, which was product costs versus period costs. Now, we hadn't talked about period costs. A product cost is any cost that attaches to the product. So if we don't sell it, it sits in inventory as an asset. The cost associated with making that product goes into inventory. If we sell it, it becomes part of cost of goods sold. So that's the product cost. It attaches to the thing. A period cost, on the other hand, and these tend to be manufacturing costs. Period costs, on the other hand, tend to be selling and administrative costs. Now, what's the difference between an administrative cost and, let's say, a manufacturing overhead cost? So, a manufacturing overhead cost would be the assembly line supervisor, the janitor of the factory floor, the rent on the factory building. Those are all manufacturing costs. We have to have those in order to do the manufacturing. An administrative cost would be like the home office. Um, they're not they're not they don't provide the anything to do with the factory. They might do HR, that sort of thing, but nothing is seen in the product itself, and nothing contributes directly to the product. So it could be the HR department, it could be the home office, it could be the vice president of design, um, the chief information officer, the chief financial officer, the CEO. All those people are administrative costs. Whereas a selling cost are things like advertising, shipping, handling, um, those sorts of things that are involved in selling costs. Selling costs and administrative costs are period costs in that they are associated with the period and not with the product. And that kind of makes sense because the product cost, remember, if we don't sell it, it goes into inventory. Well, we don't have any selling costs associated with something that goes into inventory, right? We don't associate the selling cost until we sell it. The administrative costs, well, that's going to happen over a period of time, regardless of if we manufacture and sell 1,000 units, manufacture 1,000 units and sell 800 units, um, manufacture 1,000 units and sell 1,100 because we pulled them out of inventory, 100 out of inventory to sell. Those administrative costs aren't going to change based on a volume. So, in a sense, they tend to be fixed costs, but they also tend to not be associated with the product. They occur whether it's sold or whether it doesn't sell. So that's important to realize period costs. Now, when we get up here, we're going to talk about I mentioned already the two different types of accounting. Um, we have full cost accounting or absorption accounting. And the product costs on absorption accounting are direct materials, direct labor, and manufacturing overhead. I'm going to split that into variable manufacturing overhead, the V for variable, and fixed manufacturing overhead. And this is all product cost. And then we're going to have our selling and administrative costs down here. Now, some selling costs are actually variable, like a sales commission, right? Even though it's variable and it changes with the volume sold, it's still considered a period cost. So product does not mean variable and period does not mean fixed, that sort of thing. However, on the contribution format, we're going to have our direct materials, so that's the same as over here. We're going to have our direct labor. That's the same as over here. We're going to have our variable manufacturing overhead. That's the same as over here. But we move fixed manufacturing overhead to be a period cost. And we move variable selling and administrative costs, usually is going to be selling, very few administrative costs that are variable. We're going to move that up here. Now, it won't be, however, a product cost, but it just gets moved so that it's not a period cost. These are product costs. So in the contribution format, instead of product and period cost, we just simply have variable and fixed. But you will see the product cost under the contribution format. So it will be those three right there is the product cost under the contribution margin format. All right. Let's talk about, we have two broad categories of companies. This class, actually, let's go ahead and make it three. Three broad categories of companies. We're going to have manufacturing. We are going to have merchandising. And we are going to have service. Okay, so manufacturing, now obviously, if you're from the Permian Basin area here, obviously we have another category that's called extractive, which also includes any mining or timber type of activity. It broadly gets categorized as manufacturing, but it kind of is a separate category that very few textbooks talk about. But so extractive would be a fourth category, if you wish. So the important part of this, though, is manufacturing has three inventories that are important inventories. They have a raw materials. They have a work in process. Work in process just means we've started it, but it's not ready to go to finished goods and be sold. We've started it, but we haven't completed it. And then finally, so through work in process, and it just depends on the type of industry, whether work in process is big or small. For example, in a lean manufacturing where the manufacturing process is fairly short, you may have work in process that is negligible at the end of the day or into the accounting period. I went to, when I was a graduate student, I toured a calculator factory. And one of the things, they showed us their assembly line. It was after hours, but they would come in at 7 o'clock in the morning and they would get deliveries. It was a just-in-time factory. They would get deliveries at 6 o'clock in the morning. The workers would come in at 7 o'clock in the morning, and the amount of work left that was unfinished probably didn't, they were producing tens of thousands of dollars in calculators a day, and the work left on the table was probably less than $100 worth of goods sitting on the table. It just, things that didn't match up. They had extra key parts or extra cases, but they didn't have screens, so they couldn't finish them up, that sort of thing. But they timed their delivery, so they got it in that morning. So it could be very small. On the other hand, somebody like Boeing Aircraft, where it takes months and months to complete a single unit, at the end of the accounting period, they have millions of dollars in work in process. And they're going to have more money in work in process than they have in finished goods or raw materials. as needed, because it's just the nature of the business they're in. So work in process can be large, it can be small. And then our last inventory is finished goods. In a merchandising company, um, they are only going to have one. Now, merchandising company would include both wholesalers and retailers. And if you're aware of how business works, it could even be a jobber. That a jobber is somebody that's above like a wholesaler. They lots of times there are people that import from one company and then spread it out to wholesalers, that sort of thing. But they have one inventory, and that is their goods inventory, right? It basically, when they get it, all they're doing is being a middleman. They don't change much. If you were to go to Dillard's and buy some clothes, for example, they might do an alteration, but they're not going to do major construction work on a set of clothes or something like that. Most of their products, there's going to be no um, alteration to from when they buy it. The only thing they do is break down the size of the sales unit. They're going to take a pallet or a case and sell it as a single unit, for example. um, and then in a service company, you have no meaningful inventories. Now, well, what about like a doctor's office? They're going to have a few inoculations. Obviously, they're going to have um, uh, syringes and needles and various sorts of things. All of these are going to have all these three groups are going to have office supplies inventories. We're not talking about that sort of thing, but basically in service industries, you're talking accounting, um, um, dental, um, medicine, law, those sorts of things, car wash. The inventories are almost negligible compared to the revenues that's actually going on. Right. All right. So cost accounting very much deals with the manufacturing firms. So um, those three inventories, I want to show you how costs flow through that. So one way to do it, there's a couple different ways to do this. Any way is acceptable. I'll show you two here as we go through. You start with your purchases. This is raw materials. Start over here. You start with your purchases, and then you add the beginning inventory and subtract the ending inventory. And that will give you raw materials used. This starts our work in process inventory. So we take the raw materials used, we add direct labor and manufacturing overhead. So those are the three components that go into the work in process. Once again, we will add, these are all add, by the way. We add our beginning inventory, subtract our ending inventory, and that will give you your cost of goods manufactured. Your cost of goods manufactured is the beginning of your finished goods inventory. So those are the three inventories: raw materials, work in process, finished goods. Add our beginning inventory, subtract our ending inventory, and that will give you cost of goods sold, and that's what you got. Now I do it. This is probably the most straightforward. One flows into the other, flows into the other. I tend to do it a little bit different, just the way I learned it, and have kept doing it that way. As you'll see, mathematically, it's the exact same thing, but I start with the beginning inventory, add my purchases, and I get an interim number that is raw materials available. Then I subtract off the ending inventory, and I get the raw materials used. Okay. Then I got, so this is the raw materials. Then I do the work in process. I start with the beginning inventory, add the raw materials used, add the direct labor used, add the manufacturing overhead. That gives me an interim number known as total manufacturing costs. Then subtract off the ending inventory. Gives me the cost of goods manufactured. Then I go to the finished goods, and I start with the beginning inventory. I add to that the cost of goods manufactured. So you see this just comes here, and this just comes here, like that. And that gives me goods available for sale. Subtract off the ending inventory, and that will give me cost of goods sold. And if you work through it mathematically, they're identical. My way is a little bit longer, but I like having the goods available for sale. I like having the total manufacturing cost on an exam. Either way is perfectly acceptable. I won't mark you down on if you choose either way to do it. It's fine, because obviously this is shorter, a little more efficient. Time is precious on exams, so you may want to do it that way, unless I'm specifically asking for total manufacturing cost or something like that. But I think those are important numbers. So that's our flow of goods, flow of costs through the goods. And the last thing I want to talk about in this chapter is put my little blotter page in there so it bled through. The last thing I want to talk about is inventory systems. We have two types of systems. We have a periodic system. That's old school, old style, before we had point of sale things like barcodes and stuff like that. The periodic system um, is useful, but it doesn't give you interim information. With the periodic system, you start with your beginning inventory, you add your purchases. That gives you your goods available for sale. This is a merchandising company. Subtract off your ending inventory, and that'll give you your cost of goods sold. So until you take that final inventory on a periodic system, you won't know what you sold. The journal entries that go with this is when you buy something, it will be, let's say we buy $100 worth of goods, it'll be purchases 100, and then we'll have accounts payable 100, and of course there'll be a T account called purchases, and we'll have all of these, throughout the year. Add them all up, and this purchases will be the purchases that goes in there when we're done at the end of the accounting period. Do that. The bad thing about a periodic inventory system is we don't, we can take a look at the shelves, something like that, but we don't know for certain what we have or what should be in inventory. Until we do that final inventory, we know what's there and we know what our cost of goods sold is. It makes it a lot harder to estimate your income as you're going through. You just have to do it by ratios, is how you estimate that in that case. Then on the periodic system, the perpetual system, you start with a beginning inventory, but then you add inventory every time you buy something, and you subtract inventory every time you sell something. And obviously, if you go to any grocery store, you go to most retail stores, they have point of sale. They just scan the barcode, and they're able to tell you what's there. So you always know. So your inventory, um, you're going to have the beginning balance, right? And then you'll have your pluses here and your minuses here when you sell something. And then when you add this all up, this will be your ending balance. Now, does that mean that you get to do away with inventory? Absolutely not. The reason is because every organization faces shrinkage. Shrinkage are things, it's not all malevolent. Um, some shrinkage is just, a kid runs through the store and breaks something, breaks a glass bottle, and, oh, no, mom, we're not going to charge you for that. She's got 2 basketful of groceries, and you're not going to charge her for a $2.50 bottle of tomato juice, right? Um, so, there's that. But then there are things that just walk out the store, both by employees and shoplifters that should have been paid for but weren't. And that in the industry is known as shrinkage. And so you do have to still take and to do a final inventory in order to find out how much that shrinkage is and what that ending balance actually is. Uh, you can see that on retail accounts if you look through the footnotes of the financial statements of a retail industry. They will tell you what shrinkage is. They go to great lengths to try to limit that shrinkage. Everything from Walmart having the greeters and people checking your receipts. I totally by accident tried to walk out of Sam's. They actually caught me. Tried to walk out of Sam's without paying for a block of cheese the other day. I had it sitting under one of those giant containers of Kleenex, and it was just, I didn't realize. She goes, "Oh, you're missing something." I go, "I am," and so we picked it up, and looked around, and oh, there it is. So went back and paid for the cheese, and apparently that happens a lot. But that was not intentional at all, but still it happens. That's going to happen with the self checkout type things. So that's they check receipts in order to prevent slippage like that. That would have technically have been slippage. I've actually done that, not on purpose. And um, the next time and found it when I got home, and next time I went back through, I rang it up and then put it to the side so I paid for it. But it, about a $7 item or something. But so shrinkage is a very big loss. You can about each organization is different, but about $1,700 per employee from retail associations that we not all of that is the employee shrinkage, but that's one of the general measures, about $1,700 per employee on shrinkage of various things. So you still have to take a final inventory, but that's how we do that. All right, so that's going to conclude this introduction to costs, terms, and concepts. And so we will see you on the next video.